Now, what I think is noticeable or notable, I should say, and what I want to kind of report on from a specific data standpoint is, and again, this was data that was released in mid-December. This is a Yardi Matrix report. Average U.S. rents fell $8 to $1,740, average across the country in November, which, and this is what's notable, marked the fourth consecutive month of decline, while year over year rent growth dropped over 30 basis points to just 0.2%. So rent growth is now at the lowest level since the first quarter of 2021. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to share 3 articles or pieces of data or news that I find to be very interesting as it relates to how we are thinking about making investing decisions in our business in early 2026. And my goal in this episode is to share some information that may inform how you view the multifamily real estate investing landscape, and then downstream from that, how you think about investing as you get started here in 2026. And a couple of these are going to be maybe a little bit more revelatory for some of you. A couple of them may be repetitive. But broadly speaking, I think that these are 3 trends that are sticking out to me in early 26 that we are keeping an eye on. Number one actually has to do with the single family housing market, which is a bit of a deviation from what we talk about on this podcast, obviously. But both the multifamily real estate market and the single family housing market are somewhat intertwined in the sense that when the single family market is humming, when there's more sales, when there's more transactions, when more people are buying and selling homes, there's a downstream positive impact to the rental market, fundamentally speaking. A lot of people think, just at the surface level, that when there are less homeowners, that means it's better for apartments, right? That's better for the folks who own multifamily real estate because you have more folks who are looking to rent versus buy. And while there is some truth to that, that typically is indicative of a poor economy or a less weaker economy, I should say, when less people are able to buy homes and when housing becomes more unaffordable. And the other piece of this that is important to mention is that when there is more, when more people are just fundamentally moving around, whether that's buying a house for the first time and moving out of an apartment, or somebody's selling a house and deciding to rent for a while they look for an apartment, or when people are rising through the ranks from a rental standpoint, from a class of real estate standpoint, moving from a C class apartment to a B class apartment, and then buying a house. And the person who sold the house is buying a house, or they're becoming a renter in a B class apartment, which then increases the rate of B class apartment rentals. And then therefore the folks who are looking to rent B class then move into C class. There's an element of when more people are just moving around, it's actually, it's a sign of strength in the rental market, right? And rents grow at a higher rate. And this is what we saw in 2020, 21, 22, like the peak zero interest rate COVID phenomenon here of money's so damn cheap. So you're having all of these people buy houses, move around, sell houses. There's all kinds of liquidity in the marketplace from a housing standpoint. And that trickles down into a healthier economic position for the folks who are operating multifamily housing. So the struggling single family housing market of the last few years is not entirely why we're having issues in multifamily by any means or stretch, but it is a component of it. So a piece of data that I find is interesting, and this was reported by Fannie Mae, or this is pulled from Fannie Mae's mortgage database, and I grabbed this from the data team of a lender on LinkedIn, funny enough, but it's sourced from the Fannie Mae mortgage database, is that for the first time since the mid-2010s, over 20% of existing mortgage holders, this is single family housing, carry rates above 6%. And again, that's a share not seen since the mid-2010s. And I think what's most important here is that number, that 20%, slightly more than 20%, I believe it's 21.2% of mortgages on the single family housing market, at least pulled from the Fannie Mae database, have a 20%, or excuse me, a 6% plus interest rate. And that now exceeds the subset of mortgages that have a sub 3% rate. And there was a dynamic for many years here, really from when interest rates started to increase in early mid 22 till now, January of 26, coming up on almost 4 years, where people didn't want to sell their homes because they didn't want to give up their rate, fundamentally speaking, and that restricted inventory. And now, for the first time since really 2020 or so, we have more folks with a 6% plus rate than a sub 3% rate. And therefore, I think downstream, an effect that that's going to have in the marketplace is that more single family homeowners are going to be willing to sell comparatively than to the last few years, 4 years, call it, because they're trading out of, a 6% plus rate into another 6% plus rate versus a 3% rate to a 6% rate. So I think this is something that we're going to see in the multifamily market as a result of downstream higher transactional activity on the single family side is more household formations, more demand from an apartment standpoint, I should say, because more people are going to be moving around. Number two, and this is, a piece of November data that was reported in December. So I'm a little late on sharing this, but I think it's still a trend that's carrying into early 26, is just the flatlining of rents across the board, from a nationwide standpoint. And again, that's a broad statement that I'm going to unpack. We are all aware over the last few years that rents have taken a dive in the high supplied markets, or significant supplied markets of the Southeast, Southwest, the Sun Belt. We're talking the Texas market, the big markets in Texas, Florida, Arizona, all of these different markets that saw a lot of supply built from 2018 to 2022, or I should say 24, when a lot of that was completed, just saw rents kind of take a dive. That said, during that same period of time, broadly speaking, in the Northeast, the Midwest, the West Coast, rents stayed pretty strong, right? If they weren't increasing, they were at least not declining. And that's in part due to just less supply being brought online. Now, what I think is noticeable or notable, I should say, and what I want to kind of report on from a specific data standpoint is, and again, this was data that was released in mid-December. This is a Yardi Matrix report. Average U.S. rents fell $8 to $1,740, average across the country in November, which, and this is what's notable, marked the fourth consecutive month of decline, while year over year rent growth dropped over 30 basis points to just 0.2%. So the big thing here is for the fourth consecutive month, rents declined, right? The average rents declined nationwide in November. And let's put that into some context. So rent growth is now at the lowest level since the first quarter of 2021, which is when the market was finally beginning to recover from the pandemic there, when rents slashed, early mid 2020, right when the pandemic hit and everybody froze and it was really hard for anyone to lease apartments. So generally speaking, that's a big deal because that indicates that even the more sticky markets from a rent growth standpoint have struggled. So, some other kind of pieces of data here that really communicate that are even the top performing markets such as Columbus, Ohio, Indianapolis, New Jersey, San Jose, California, San Francisco, saw advertised rents turn from positive to negative. And these are markets with above average occupancy rates relative to the nationwide average. And, that I think is important because these are specifically markets that have always popped up in the top 10, top 5 list of rent growth and occupancy over the last few years, while the markets that were hammered with supply obviously struggled. And seeing those markets, obviously, in terms of what we're talking about here, also see reduced rents for a number of consecutive months and year over year is notable. That means that there's like a really meaningful decline in demand right now. And we're noticing that in our portfolio just anecdotally as well for all the properties that we're managing in New Hampshire, which is a market, the Manchester, Nashua, Southern New Hampshire region, which is about, for those who aren't familiar, 45 minutes north of Boston, just over the Massachusetts, New Hampshire border, kind of an extension of the greater Boston area. We're just seeing rents decline, right? I mean, it's fundamentally that's what's happening. And it hasn't happened until late 2025. And this data is backing up what we're seeing on the ground. And it's the same thing happening in greater Boston. We're seeing year over year rents decline in Boston, which has become one of the highest rent growth markets in the country because of just the combination of demand and limited supply. And we're still seeing rents come down in those markets. So long and short, there's some seasonality here, that's at play. Rents always start to grow at a slower pace late in the year comparatively to the late spring, summer, early fall timeframe. But what we're seeing is declines that are outpacing what's traditional season or kind of what can be attributed to the traditional seasonal slowdown. So we're assuming that heading into 26, we're still not going to see much rent growth. A lot of people seem to think that because we're going to have much less supply heading into 26, that rents are going to just rebound and start growing at 3-4% again. We don't believe that to be the case. We're not predicting that rents are going to grow really in any material way in 2026 because of what we're seeing from a demand slowdown here heading into the end of last year and into early this year, which is funny because that somewhat contradicts what I'm talking about from a single family housing transaction standpoint. And that's going to help demand, but I still don't think that's going to drive demand in any real meaningful way to where we're going to see like significant lease trade outs from or rent increases on lease trade outs. The last, this is more of a trend than an article, right? Or some type of news, although there is a piece of news that, a couple pieces of news that I can point to here is that, it's funny, I mentioned this in my kind of year end eight trends we're keeping an eye on podcast episode that I released a couple weeks ago at the end of 2025. But again, I really want to drive this home because I think it's just going to increasingly become something that we're evaluating internally in our own market and something that we're keeping an eye on is just the continued politicization. How do I say this? The continued political focus would be the easier way to say this on just rental real estate, on people who rent real estate, fundamentally speaking, whether that's some guy renting a duplex or a large property management company renting out, large apartment communities. Regardless of who you are as an investor, whether you're the big investor with thousands of units or the guy who's got a couple buildings, like just legislation around landlord tenants laws, around eviction laws, around rent increases, around rent control, around just fundamentally speaking, private property rights is going to become as relevant in a market when you're evaluating a market as anything else, as rent growth, as job growth, as population growth, et cetera. We're fortunate in the market that we primarily transact in, New Hampshire, being a fairly property owner, property management company, landlord friendly state is very broadly speaking. I mean, much less so than the states in the Midwest, the Southeast, the Southwest for sure, but much more so than the states that it borders in the Northeast of the United States. That said, the pendulum is starting to swing here and the spectrum is starting to widen as it relates to the landscape of landlord tenant housing laws kind of in different markets throughout the country. And the gap is getting wider and wider. And, there's a couple of things that we can point at here, right? Massachusetts is going to vote on statewide rent control in late 2026, and it's very prohibitive rent control. This isn't citywide, this isn't countywide, this is statewide. Whether you're in downtown Boston or whether you're in a small rural town in Western Massachusetts, you're going to be affected by this, right? And this is an extremely meaningful piece of legislation that has immense downstream impacts on both, tenants and property owners. And it's negative for both parties, in my opinion, right? But that said, like it's important for you and your market to keep an eye on this, even if you don't have a piece of impending legislation that is that significant. You should continually keep an eye on any smaller changes in the markets of which you're investing, such as different, licensing requirements at a city level to operate rental housing, different changes at the federal level related to various housing assistance programs. For example, I think the Federal Housing Authority is going to be funded with less funds at the federal level. And this, don't quote me on that. I believe this is maybe something that's being introduced, but I think they're going to be less federal available funds for housing programs specifically that support residents, right? And if that's a primary focus of your strategy, which is leasing to Section 8 or housing assistance tenants, whether you're doing like LIHTC stuff or you're doing housing assistance program stuff, encumbered buildings that are where you need to lease to some percentage of, or where some percentage of your tenants need to be under a percentage AMI, and that therefore means many of your tenants are housing assistance tenants. Like these are things that you really need to be keeping an eye on right now, because this landscape is changing at a far higher rate than it has since I've been in the business, which has been since 2016. I think another large kind of leading indicator of the increased divide in the view from a views upon housing legislation standpoint is, Mr. Mayor Mondani there in New York appointing somebody, and I'm forgetting her name, but his appointee for the tenant advocates position within his cabinet is quite frankly so outwardly vocal around removing all private property rights. But this is above and beyond any like rent control stuff. This is like, we do not believe in private property rights. We do not believe in an individual's right to rent a property and we view housing as a collective property versus an individual property. Like really foundational deviations from how, fundamentally speaking, real estate has been viewed and private property has been viewed since the conception of the US, right? I mean, these are like big statements I'm making, but when people like this are put into positions of power in major cities, even if you're not somebody who's investing in that city, these are things that you need to be mindful of, right? Does that mean that the local government, the state government, or the city government, and where you invest is going to drastically change the approach to landlord tenant and housing law? No. But it does mean that like you really need to keep an eye on what's going on in the market that you're investing in, because these things are changing at a higher rate than they have been historically. And all it takes is like some murmurs, like this is what's happening in Massachusetts, right? Just like middle of last year, this wasn't on the radar. By the end of last year, and when I say this, I mean the legislation from a statewide standpoint around rent control. By the end of the year, it was the group that was trying to put this on the ballot received enough signatures to get it onto the ballot. And when you actually start combing through the fine print, you see that there are some retroactive components of this bill passing that would be extremely prohibitive to folks who own property right now and who are, outside of just folks that are buying buildings potentially after this legislation passes. And you need to be able to act quickly to adjust how you're operating your buildings to protect yourself against different changes in the marketplace in terms of what's happening, right? This could be something as simple as like no cause evictions, right? Where you can't non-renew a tenant's lease for a reason outside of non-payment. This is something that's happening in many cities around the world, or around the country, I should say, where the state or a city will say, I understand that you are renting, an apartment in your 3-unit building to this tenant, and now you want to move into that unit. Or let's just say you have a family member who you want to move into that unit. So you give this resident, 90-day notice before the end of their lease term, and that you're not renewing their lease and that they have to move out. And there's a lot of cities and states that are passing legislation where it's just like you can't do that, right? Where you can never non-renew a lease unless you're evicting for cause, right? And there's, again, it's all in a spectrum. But I think what I'm trying to get across here is if you're somebody who's kind of laissez-faire and you're not really like actively looking for updates on this front, and you're kind of deferring to your property management company, or your way of acquiring news is just kind of waiting for someone in your market to bring it up to you, you may need to switch into being a little bit more proactive around this and just looking at different bills that are being introduced at the city level, at the state level, et cetera, to stay ahead of any potential kind of political changes around how the state and the city is going to allow you to operate your buildings. So long story short, I think the first two are a little bit more tactical from a data standpoint. The third one is just a trend that I think is important for people to keep an eye on who are buying and operating multifamily housing. Nevertheless, I appreciate you guys for listening, and I hope you continue to listen here throughout 2026. We crossed 300 ratings and reviews, at the end of last year, which was a really significant milestone for the podcast. And appreciate everybody who left a rating, left a review, and thank you all for continuing to tune in and listen week over week. I'm looking forward to a great 26 here on the podcast. We've got some great guests lined up, and I'm going to start doing some unique things with the show as well. Some mailbag type stuff, some question and answer type episodes where folks can shoot me questions and I'll kind of rattle through them in a solo podcast format like this one. So if you're somebody who wants me to cover a topic, shoot me a DM on Instagram at Multifamily Wealth, or just, send me an email, Axel, AXEL, at alignedrep.com. But as always, again, thank you for listening, and I'll catch you guys next week.